Hi everyone, this is the 22nd of October 2018. Today I'm going to touch a little bit about on the bond market and what has been going on and how we should relate it with our market and the economic winter cycle. That said, first, the Nifty's closed down this week after having a positive week in the previous week, and prior to that we had a 5 week continuous sell-off. Now the largest part of the sell-off this month occurred between the 3rd and the 5th of October. And after that, we've mostly seen the Nifty bouncing about between 10,200, 138 at the lower end to 10,500, 10,700 at the upper end. But we spent 3 weeks bouncing around this range up and down without really making much more progress than that. So we've really gone nowhere. And this range has ended up being around a 38% retracement to the entire decline that we've seen from the start of September. Now, I would have expected the bounce back to be larger in terms of the retracement and probably faster, though we did see some kind of speed in this move because it's been pretty volatile. At the same time, there are some stocks that have continued to decline, which is why it looks like the market is still weakening. However, we've found support near the trend line of the last two important swings, which is what I had shown in my weekly chart, and that trend line is at around 10,240, 250. And at the upper end, we broke the trend line, which was the falling trend line, rising trend line from the March low. And having broken that, we've taken support at the first line, and we really attempted to bounce back and move up to the second line. The question is, will we really get there? We've actually come very close to kissing the 40-week moving average, which is which was at around 10,750. So we reached 10,710. We haven't really gone to the 20-week average, which would have been closer to 10,850. But we can attempt that as long as we've really not broken this shelf support. Talking about much lower lows, as some people are beginning to do, is something that I'm not jumping to yet, simply because some of the readings, some of the sentiment data that I track is beginning to have readings similar to those that we had at the end of March when the market bottomed at 9950. So we're getting similar kind of readings, unless you can really say that despite these readings the market will continue to fall, which it can. This is the market. I would really now want clear-cut signs that it's happening than really preempt the call and want to wait. So which is what I think I said even 2 weeks ago. But then, like I said, we're still at the same level as far as the index is concerned. We've seen some weakness in stocks. We've seen some strength in some of the stocks, but I think there's room for some more bouncing about still for the sentiment to really cool off from where it is. That is, the negative sentiment has to actually reduce a bit before things can really get worse. So, in short, what I'm saying is that my expectation of further downside right away has been pushed back a bit because of this extreme reading, and because stocks have already fallen quite a bit across the board, and I would want to see us come out of those oversold readings before you really continue lower. So that has really not happened meaningfully in this in the last 2 weeks, where we've bounced back to 10,700 is my sense so far. In the meantime, what I also thought is that we would get alignment between various of these markets, which is the global equities, because you had the emerging market space that bounced off in the early part of September once the tariffs were announced by the US, and moment they did, because that news had been well anticipated, both Asia and the US actually rallied after that news for a couple of weeks, and then they started to weaken again after that. But now that weakness has become pretty steep, you're seeing a pretty sharp sell-off in the last 2 weeks in the emerging market index. The question is, will it again pull back? And simultaneously, we've also seen a steep sell-off in the US, which was the final market to break. So now you have all the markets breaking down together. Question is now, will they all bounce and fall together, up and down simultaneously? Ideally, that's what should happen. But at this point of time, the Dow, S&P have also reached, or the Nasdaq all have reached close to their 200-day average or the 40-week average, which I track, and they've actually not all closed below the 40-week average, which is also what happened in March and April of this year. So unless we really break all these multiple supports that have held again and again, we really don't know whether we are heading much lower right away. And the question then is, are you really going to have a rally? Because some of the US indices, and essentially I think the Dow did not show a very, very clear 5-wave decline in this sell-off. But then again, there, there have been some count issues. Even the early sell-off which we saw in Jan and Feb looked like it was impulsive, but then eventually became a triangle and you got a new high again. So again, this fall is not looking impulsive, but let's see if the rallies hold. But the question is, as long as you're not really breaking these shelf supports, will it attempt to make multiple rallies again and again before things get worse again? So there too, you got an extreme in sentiment. You had only 10% people bullish when you saw that 3-day sell-off in the Dow last week. The DSI was at 10%, and from that extreme low, you did see a bounce, but then selling has resumed last few days, but we've really not broken the lows. So I think both our market, US market, the EMs, all of them need some watching for a few days as to whether the trends down are really continuing, or is this really an oversold condition from where you're going to continue to pull back much more slowly rather than extremely fast as was happening in the earlier period. So if that's true, then it ends up becoming a 3 to 5 week kind of a consolidation phase or a retracement phase, which means well up to maybe at least Diwali, which is still another 2 weeks ago, we might still be in bounce mode, and whatever would happen would probably only happen after that. But looking at long-term charts, no change in my opinion that we are already in a bear market. That said, nothing occurs in one way in this trend, so you have to look for points where it's going to move up, then down, then up, then down, and you'll have to point out those specific levels at where things can turn and act accordingly. So that kind of risk management becomes far more an active requirement in bear markets than in bull markets, where more or less you end up holding on to a lot of the trend. Retracement and pullbacks are often small. So very, very different environment, and this environment has been building, I think, for more than a year, because we've seen volatility in the mid-cap space even last year. Now, where did all this volatility start from? Some of the largest part of news which came out through September was related to NBFCs. Now, I would have written this, I think, months and months ago in my economic articles, that eventually you have to see problems show up in this space, because when we are talking of an economic winter, we are really talking about problems in credit, and problems in credit cannot be only related to public sector banks. They're going to be related to private sector banks. They're going to be related to NBFCs. The only thing is they will only come out and make headline news as the economy slows down or as credit availability actually becomes an issue. Now, one thing that the NPA issue has done is it has actually pushed banks back in terms of lending, which is where the entire growth phase for the NBFCs came in. But NBFCs typically being always having asset liability mismatch issues, which now, as everyone says, was nothing new, because that's how they always function. My question is, then why did you even give them high ratings when that's the way they function? So I think that went on for a prolonged period of time, but now some of those issues have come to the face, and the government has taken a lot of steps, I think, in the last month to try and push back credit issues, to push back currency issues. It has taken steps on the oil front, so that the oil marketing companies can actually borrow in dollars and pay for their purchases, and as long as they do that upfront, temporarily, the demand for dollars would actually slow down. The only demand is then coming from maybe FII selling, which has been an ongoing trend, but at least the biggest demand which comes from oil has been pushed back. Similarly, steps taken to provide liquidity to the credit markets in the commercial paper market, asking the PSU banks. SBI has announced that it would put up more funds to NBFCs, raising a limit which it did just yesterday from 10% to 15% for some credit limits which exist for the banks to lend further to NBFCs is also another means where they are trying to provide credit. The question is really, had they not even reached the 10% limit, because I don't know. Still, the government has said, fine, go and lend 15%, because they want you to provide that liquidity, and some of the NBFCs might get it at higher rates of interest, because they might still be considered safe, because most of the issue, as many are coming out and saying, are more related to liquidity and not solvency. But my sense, we are in an economic winter. Problems are going to become solvency issues for some of the banks, and liquidity issues are just part of the show, because the moment your interest rate costs go up, then the real earning potential for the lender become really narrow, because their cost of funds to their lending rates narrows down and goes to zero if your cost really goes up substantially. And if they are not going to find lending easily, then eventually that's what is going to be the case. The real question then is, are interest rates going to continue to rise? At least in the short term, we are getting this trigger where yields, bond yields on the 10-year GSEC have pulled back from almost 10.1617 to now below 8%, and now probably I feel heading towards 7.69 being the previous swing low base support that I think will hold. But we have room till there to really pull back. So yields are pulling back, the currencies pulled back a bit, still not broken the 20 DMA, but efforts have been taken to pull it back. And most bond yields, I think, around the world are actually pulling back, except for the peripheral European countries, which have suddenly now gotten into trouble, which is Italy and Spain, where you're seeing spikes in bond yields. But bond yields in most of the BRIC nations have actually been cooling off over the last month. China, Brazil significantly, because Brazil was in a lot of trouble. Its currency also strengthened significantly in the last month or two, which is why you can see the Brazilian stock market has been one of the best performing markets suddenly in the last 1 month. So only thing that would pull that back would be weakness in the global equity space or in the US market. Otherwise, that market has already stabilized. You're still not seeing stability in China though, because you have this continuous rhetoric around trade wars still going on. So similarly, India, so many steps have been taken that once you're seeing stability in the bond and currency space, at least in the short term, that should provide some support to the market, even though it doesn't seem to have done so. I think that's what we would really keep watching over the next week or two as to those trends really changing. But as long as you have strength there, I think eventually you get some kind of support till the next round of trouble really shows up. But the next round of trouble, my sense is, if not now, months down the line will again show up, because this is a credit cycle. As the economy remains flat, you're going to have increasing number of NPAs even in the smaller lending space, and eventually as that happens, if interest rates go up and you have higher NPAs, you're going to have not just liquidity but solvency issues. But these things are not going to happen overnight. What you just saw was the first round of issues propping up, and I think that's the precursor to a lot more happening down the line, but probably not yet. But you have to stay prepared, because you don't know which will be the next shoe to fall. In the meantime, everybody's figured out that the costs are going up and the lending differences are going to cause profitability to squeeze, which is why the high valuations that the banking sector was really getting is already getting derated, which is why you have many of these financial stocks, housing finance companies, actually weakening right now, which is more a case of derating rather than earnings growth having really reversed as yet. That has not yet significantly happened. So this is just one step in that direction. It reached a high level of valuation, and now we are really correcting a lot of what is happening because of the trends that have unfolded. But these trends are likely to continue, and therefore the unwinding process may also continue over a period of time, and the troubles will continue to show up and prop up till we actually fully deal with and resolve what is globally the biggest jump in corporate debt in recent times. So most of the fresh debt, the entire debt expansion that has happened post 2008-9 has now increasingly become apparent. I think not just now, I think even a year back the data was apparent that almost $7 to $8 trillion worth of new emerging market debt had been added up, and a lot of that was in corporate debt, which is borrowings by corporates in dollar denominated assets. And in some places, like in local currencies as in India, it would also be in rupee denominated debt. So essentially it's been a bubble in corporate debt. Everybody's gone out and borrowed at lower interest costs that were available. In fact, my sense is that a lot of the NPAs that we are really hearing about, initially they were all being funded by banks providing fresh loans to pay over previous debts, and it was really not coming out as to the size of the NPAs, because they were being allowed to hold on to the existing loans, or they were provided fresh loans to hold on to to be able to pay their previous loans, and so on. That went on till the RBI really stepped in and nudged the banks to start announcing what was really on their books. But that only continued till Raghuram Rajan continued in office. Now that said, as the PSU banks have stopped lending to the various entities, the question is where would they be getting funding from in the meantime? And part of that answer might lie with the non-banking space that has been very, very active. Of course, not all of them are in corporate lending, but many of them are and would be. Some of them have only spread themselves deeply in the retail space, lending to, for cars and houses and so on. And many have gone deep into the rural loans, which in my head would be higher risk loans. Sure, they have been extremely profitable, but at the same time, in any slowdown, those loans are also high risk, which is why you always have the highest debt ratios and loan troubles that even the PSU banks have faced, often from rural loans, and you have them getting bailed out from time to time through farm loan waivers and so on. So that's where the big growth in business was, because MSPs and various steps actually, and a very good period of farming, because we had year on year good monsoons, provided for that demand that these financial companies were able to go and cater to. And so that phase essentially, I cannot say it's come to an end because it's still continuing, but my point is that they are higher risk loans. But a lot of financial companies may have also been involved in funding a lot of the corporate debt, because that needed to be funded, and it's very, very hard to pinpoint because as we are seeing in the ILFS case, multi-layered structures, SPVs, to try and mitigate that risk so that risk really doesn't show up on their balance sheets. These are all techniques that are taught to you when you really do an MBA as to how to create vehicles and manage risk. But I mean, it's always bothered me that risk really never goes away. You can shift it to another vehicle, but does that mean that risk is out of the system? So it really not. It's just been passed from one entity to the next, and you can say that fine, if it's the other entity's problem, it's not my problem. But what impact it does have is, if it's widespread, then it has a direct impact on the economy, because suddenly all at once, when a lot of entities and loans go down, then credit markets completely slow down. So a lot of credit just halts. Nobody really wants to lend anymore, and people are more busy conserving funds, conserving their assets, rather than taking on additional risk. So that's the environment, and that's a typical environment of deflation. If you really read Conquer the Crash, which Robert Prechter wrote way too early. He wrote it early because he saw these cycles coming, and these cycles only started playing out for the US after 2008, and I think it's playing out for India after only now. After, I think, in terms of being visible to everyone, after 2015, but I cited it as the most important factor after 2011, which is exactly where most of the high debt companies, whether in the power or other infra sectors, topped out in terms of their stock market performance. After that, none of them have really performed. The only thing is those problems did not come to the fore, and now that they have, and if it's widespread to various parts of the financial sector, then lending essentially comes to a crunch, because it's lending is psychological. The moment you get scared that your loans are going to turn bad, you stop lending, and then credit growth really dries up, and that's what causes an economy that is credit based to contract. The slowdown in credit, and not really anything else in terms of the demand factors. But even if there's some pent up demand and it doesn't get funded, then that demand goes away, and suddenly you have a slowdown. So there are two different ways that this whole demand supply function can work. In fact, I'd shared on the mailing list some time back, many of you may have read the piece on credit cycles by Ray Dalio. And so he wrote an entire book, and he made the book is either, if you want it in physical, it's paid for, but if you go to his website, the link I'd shared to, you can get the entire book's PDF free. And he tried to highlight how these credit cycles work and where essentially the US is. But so it makes up for a very, very interesting debate, because what he's trying to say is that the US is in the post 1932 environment. Now, when you think of it from an economic sense, it might sound right, and then when you think of it from a stock market sense, you wonder whether it's right. Because from an economic sense, he is right that what happened in the US, you had the Great Depression, and then 1932, once the crash was in, the central bank acted late, but it did act eventually, and started to bail out the banks. It cut interest rates significantly, And once it did all of that, the market rebounded and started to head up. Of course, it took more than 10 years to go back beyond the 1929 high, but the market had significantly recovered, the US market, all the way into the late 1930s. And then it corrected, and the rise was 5 waves if you actually look at that chart. So that was wave one of a new bull market, and then it retraced 61% of that in wave two, pulling back all the way into 1942, which was World War II. Similarly, in 1970s, also once you had the consolidating bear market, you had high inflation, high interest rates in the US. The market stabilized at one point and then started to rally and pulled back only when interest rates were hiked to control inflation by Paul Volcker, and that retracement also was 61% of that first move, which can be marked as wave 1 and wave 2 as well. So what Ray Dalio was trying to say is that we are already at that point where we are past the 30s, and if the US does face another bear market, and this rally has been 5 waves now from the 2008 lows, then what you essentially get is only a wave 2 pullback, and which is more where the issues were more social, which is why you had World War II. It's not necessary you end up in a war, but essentially what the social studies, the socioeconomic studies by Robert Prechter show that when you get bear markets, you get social upheavals, and if you've had a previous one that causes, sometimes spills over into future issues in the midst of the next wave 2 bear market, which is why in his first book he also mentions that wave twos occur at a higher low, but sometimes on weaker sentiment or even worse fundamentals than at the bottom of the market. So you make a higher bottom on actually weaker or more negative sentiment, which is what we call wave 2. So that tends to happen because of the spillover effects of the past social mood, and that's what Ray Dalio tries to say is likely to happen, at least in the US case. But my sense as far as India is concerned, we really didn't face that crisis in 2007-8. For us, it was simply a correction along with the world markets. Our GDP was still growing at 7% post that crisis, and since we tried to stimulate it from the lows in the stock market, we ended up getting high levels of inflation in 2010 and 11, where food inflation had almost hit 17% at one point of time. So did we really need that stimulus since we were still growing at 7-8% is a big question that we can really ask. But I think they wanted to inflate the markets, and they did. The point is that India now, after 2008-9, has started facing higher and higher levels of debt. The public debt has actually been coming down because the government continued to focus all these years on bringing down its debt to GDP ratio. But what we got as a huge expansion in corporate debt in this entire period post 2003. In the initial period, it was positive because it led to a huge capacity expansion across various important sectors in the infra and power area. But as many of those projects got into trouble and they continued to take on more and more debt to stay afloat, we ended up getting this huge expansion in corporate debt, which now is in my last study, and I'm going to do an update, was already past the 70% mark. And then you add another 10-15% for NBFCs. The question is, those numbers might be even higher because the last study I posted was 2016, and I don't post these every month or so, because these are long-term cycles and you want them to develop over periods of time, and we are working the numbers out to see where we stand, and then I would have another report out on it hopefully soon. But the sense is pretty clear. Last 2 years there's been a huge expansion in NBFC loans. I've already seen that much data being published by some sites, and so that would push up our total debt to GDP even higher. And the government debt to GDP, which had actually come down to 63% at one point with new data and base effects, I think last number I'm seeing is around 67-68% again. So put that all together, the last time we were at 150 to 160% total debt to GDP, private plus public sector. This time around we would be even higher. I think we may have crossed 170%, which is essentially the number at which US ended up with its Great Depression in 1929. So we are now in the midst of a debt cycle, credit cycle, which is why we are facing NPA problems, credit problems, and I call it India's own economic winter. And it's not going to end till we actually do bailouts and convert a lot of this private debt into public debt again, part of which you're seeing when public sector banks take on those debt loads, or when government bails out the public sector banks. It's all a process of slowly monetizing or shifting the private debt to public debt as part of the process of restructuring the Indian economy. And that's a process. It will take a couple of years, maybe many years, depending on how fast we move. But in the meantime, as long as credit does not continue to expand, the economy itself, by any bent of logic, without doing any math, is likely to be slowing down. That's all in this update. Thank you.